navigating the world of business income and expenses for taxes in India. It often feels like a pretty complex maze, doesn't it?
It really does. A lot to keep track of.
But what if there was a tool, like a shortcut, specifically designed to cut through that complexity? Something for, say, financial years, 2024, 25, and 2025, 26.
Well, that's exactly what we're diving into today. We're going to unpack this specific business income and expenses tax calculator.
Okay.
The mission here is to show how it doesn't just simplify the math, but actually highlights these crucial details. It helps you, the user, make really informed decisions about your tax regime. It's about getting those strategic insights.
Okay, great. So let's jump right in. When you first, fire up this calculator, what are those initial things it asks for, and why are they so critical for tax planning?
Right. The power really starts the moment you tell it who you are and which year you're looking at. You just select the financial year 24-25 or 25-26. Then your taxpayer age category. So that's below 60, senior citizen, which is 60 to 79, or super senior citizen, 80 plus.
And that age part is important, right?
Absolutely pivotal. It directly impacts your basic exemption limits, especially if you're looking at the old tax regime. And the financial year, well, that sets the tax rules and slabs that apply.
Makes sense.
Yeah.
And then I see you hit the sort of fork in the road, normal business provisions, or the Presumptive Taxation Scheme. Can you break down the main difference there? Why pick one over the other?
Yeah, this is a key choice. And what's fascinating here is how it offers tailored simplicity, depending on your business type.
Okay.
So normal provisions. That means you need meticulous, detailed tracking. Every single income, every single expense, item by item.
Right, the traditional way.
Exactly. Now, the presumptive scheme, it simplifies things massively. It basically presumes your income is a fixed percentage of your turnover or receipts.
Oh, okay.
The trade-off. Well, under presumptive, you generally can't claim deductions for other specific expenses. So it's really a choice between detailed accounting versus streamlined simplicity.
Okay, so let's dig into that presumptive scheme a bit more. Here's where it gets really interesting, I think. How does it actually work for different people? What are those percentages you mentioned?
Good question. It varies. So for businesses, mainly under Section 44AB, think smaller businesses, your income is presumed at 6% of your turnover if you receive payments digitally or through banks.
Only 6%.
Yes, for digital. But if you receive it in cash, that presumed income jumps to 8%. So you can see how optimizing your payment methods directly impacts your presumed income and potentially your tax.
Right, that's a clear incentive for digital payments.
Definitely. Then for specific professionals under Section 44ADA, like doctors, lawyers, architects, it's simpler still. Income is just presumed at 50% of your total gross receipts. Straightforward.
Right, 50%. Okay.
And finally, for transporters, specifically those operating goods carriages, under Section 44AE, the income is calculated differently again. It's a fixed amount. $7,500 PHLADOP per vehicle per month.
Got it. So it's quite tailored. But what about those who stick with the normal business provisions? That sounds more complex, especially the expenses part. You mentioned the calculator has a comprehensive disallowed expenses section.
Yes, and this is a really powerful feature for those under normal provisions because, not every expense you pay is actually deductible for tax purposes.
Right, so this section helps flag those.
Yep.
What kind of surprises might pop up there? And maybe you could touch on why some expenses get disallowed.
Sure, and this raises that important question, why disallowances? Often it's about preventing tax avoidance or ensuring compliance with the spirit, not just the letter of the tax law.
Okay, like what? Give us some examples.
Okay, well, a common one, cash payments. If you pay more than $10,000 in cash to a single person in a single day, or it's $35,000 for transporters, that entire amount is 100% disallowed.
Wow, okay. That's strict.
It is. Another one, corporate social responsibility, CSR expenses, fully disallowed. The view is that it's an application of profit, not really a cost of earning it.
Interesting distinction.
Then there's employee contributions. If you collect PF or ESI from employees, but don't deposit it with the authorities by the due date, again, 100% disallowed.
Ouch. That could add up.
It really could. And TDS defaults are another big one. If you make payments to residents where you were supposed to deduct tax at source, TDS, but you didn't, then 30% of that payment gets disallowed. And naturally, any purely personal expenses you might have accidentally put through the business books, those are completely disallowed too.
Right, that makes sense. So you feed all this information in income, maybe some of these disallowed expenses if you're under normal provisions. How does the calculator actually, crunch the numbers? What do you see at the end?
The beauty of it is the real-time calculation. As you input these details, it automatically updates key figures right there for you. You see your business profit or presumptive income, your calculated total disallowed expenses, and critically, your net taxable income.
Okay, clear outputs. And then comes the magic part, right? The comparison.
Exactly. Here's where it truly shines. It doesn't just calculate your tax one way, it calculates it under both the old tax regime and the new tax regime side by side.
Ah, okay, that's super helpful.
Yeah, it breaks down everything. The base income tax, any Section 87A rebate you might be eligible for, that's the tax relief for lower incomes than your tax after the rebate, and finally, the health and education cess on top, all shown for both regimes.
So you can directly compare the bottom line.
Precisely. And if we connect this to the bigger picture, especially looking ahead to FY 2025-26, this comparison is incredibly valuable.
Why specifically for 25-26?
Well, the new tax regime has seen some updates, different slabs, and importantly, a higher rebate limit. Now it's up to 60,000 rebate for incomes up to 12 lakhs under the new regime for FY 25-26. So this side-by-side view really empowers you to choose the regime that's genuinely most beneficial, potentially saving you significant tax money.
This really sounds like a game changer for tax planning then. It brings so much clarity to an area that, let's face it, can be incredibly confusing. So for listeners wanting to try this out, how do they access this tool?
It's pretty straightforward. Just search Smart Study Blog on Google. That should bring up smartstudyblog.com. Click on that.
Okay, smartstudyblog.com.
Yep. Once you're on the site, look for the tool menu. On mobile, it might be in the top left menu icon. On a desktop, you'll likely see it directly on the homepage menu. Click Tool, then find and select Tax and GST India. The calculator should be right there.
Perfect. Search Smart Study Blog, find the website, look for Tool, then Tax and GST India. Got it.
Mm-hmm. And perhaps a final thought to leave with everyone.
Yeah.
Beyond just, getting the final tax number, try to understand why certain expenses might be disallowed if you're using the normal provisions. Because understanding that why gives you a much deeper insight into the basic principles of income tax law, how it views business operations, what it encourages, what it discourages. It's not just about the numbers, really, but the logic behind them. That understanding itself is valuable.
That's a great point. It's about the reasoning, not just the result. Excellent insight to end on.